This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Quiet as a mouse, Disney hits the mark on earnings and revenue, but Wall Street doesn't seem impressed. Another day, another record. The Dow and the S&P reach uncharted territory ahead of tomorrow's key jobs report. And passive or active, which type of investing works best for you? We'll lay out the blueprint. We have all that and more tonight on Nightly Business Report for Thursday, November 6th. Good evening, everyone. Tyler's off tonight. Topping our news, the Dow and the S&P 500 hitting new highs again on Wall Street. We'll have more on that in just a moment. But after the closing bell, a Dow component out with its latest results. Disney reported a solid quarter. It earned 89 cents a share. That was right in line with analyst estimates, and revenues came in slightly better than expectations. Disney shares fell in after-hours trading, but during the regular session, they rose 1%. Julia Borston has more on those Disney numbers.
Disney earnings coming in right in line with expectations on better than expected revenue, driven by better than projected results at the studio and parks and resorts. One hot topic and focus on the heels of Disney's rival CBS announcing direct-to-consumer streaming services for cord cutters, what Disney's media networks have in the works. Iger is saying he's confident in the value of the cable TV bundle.
Will there be experimentation? Yes. Might we be part of that experimentation? I think that's possible. We're taking a cautious approach here because we think that the prudent thing to do is to do what we can to maintain the value of what is obviously a value creator for this company and for a lot of other companies in the media space.
Iger noted that Disney's in the direct-to-consumer business in many ways, and ESPN has various streaming services, but that he's more focused on improving the value of the bundle. For Nightly Business Report, I'm Julia Borston.
We'll see how Disney's earnings play out tomorrow, but today, investors were encouraged to buy stocks after Mario Draghi, Europe's top central banker, deepened his commitment to stimulating growth in Europe. Also boosting the markets, more good news on the U.S. job market. New claims for unemployment benefits fell more than expected last week. By the end of the session, the Dow Industrials rose almost 70 points to 17,554. That's a new record. The Nasdaq jumped 17, and the S&P rose 7 points to its new record high of 2031. Well, with the indexes having set record after record, you'd think it's an easy market to make money in. But then why are so many of the fund managers struggling? Dominic Chu explains the difference between active and passive funds and what that may mean for your investments.
When it comes to investing, there are two major schools of thought. The first is choosing investment managers or funds that seek to outperform the market. The second is just finding a way to invest to match the market's returns. There is a raging debate on Wall Street about which is better. Those who believe management expertise can generate superior relative returns believe in something called active management. Those who believe the market can't be consistently beat and therefore simply investing in the market is the best way to go believe in something called passive management or indexing. So far this year, indexers have been able to claim bragging rights. According to investing research firm Morningstar, the average index mutual fund has gained a little over 5% through the end of October. Meanwhile, the average actively managed mutual fund has returned around 4.5%. The outperformance of index versus active is echoed in some of the biggest mutual funds. Vanguard's Total Stock Market Index Fund is the biggest stock index fund in America. It's got around $370 billion in assets, according to Morningstar. It's gained approximately 10% year to date. The biggest actively managed fund is the American Fund's Growth Fund of America, with $142 billion in assets. It's gained about 8% so far this year. Proponents of both styles of investing will point to their own stats showing their superiority, but many financial advisors believe that there's a role that each can play in a well-diversified portfolio. For Nightly Business Report, I'm Dominic Chu.
Barry Glassman joins us now to talk more about active versus passive investing. He's founder and president of his own wealth management firm, Glassman Wealth Services. Barry, thanks for joining us on this big debate versus active versus passive investing. Are individual investors better off with one style of investing over the other? What do you tell your clients?
Keep in mind that this isn't a new debate. This has been going on for a long time, ever since indexes were invented. But I think there's room for both. I think that there's room for indexes for certain categories of a portfolio. And then there are certain places where you can't find indexes. So passive certainly does make sense.
Mm-hmm. Well, there are pros and cons to both, obviously. And let's go over some of them. What would you say are the main pros for passive investing?
Well, the pros for passive are fairly easy. They're typically low cost. They don't try to outperform an index. They don't actively trade. Therefore, they're tax efficient. And then lastly, a lot of them do beat most active managers over the long term.
Mm-hmm. And so you don't have to really worry much about it. You just put your money there and you're
Set
done.
it and forget it.
Set it and forget it. Okay. What about on the active side? What are the pros there?
Well, for the active side, I believe that you should use active management with, for example, there isn't an index. We happen to use a strategy, for example, that is a long-short stock strategy. The manager can invest in certain investments, hoping that they go higher, some that they go lower. There is no index. You should use active management where the index isn't really right for you, or you choose not to be in the index. And in emerging markets, for example, during the peak of the BRIC, the BRIC, Brazil, Russia, India, China, those were dominating the emerging market indexes, and it wasn't leaving enough room for countries like Singapore and South Korea and so forth. And then lastly, if you really do believe that a manager can beat the index, then you should certainly consider their active management.
You know, one of the reasons why a lot of investors don't like the active investing is that they put their money in what was a hot fund, only to find out maybe the next year or the year after it does poorly and they're disappointed. And what's the advice that you give to investors on how to research whether you put your money in an active fund or not?
Sure. This is the biggest reason why people should stay away from active management, is if they're going to make the I guess it's a human decision, the gut decision to sell something after it's underperformed. So if they choose to go with a man, woman, or team, believing that they can add value beyond that of the index, you just have to realize that there's going to be a year or two where they absolutely will underperform the index. What you don't want to do is sell out after they've underperformed and then just choose another active manager who has recently outperformed. What you find is people will start just selling low and then selling low again and selling low again. And it's a recipe for vast underperformance.
A couple of months ago, you'll remember that Warren Buffett disclosed that he told his wife that when he's no longer around, she should put the money into an index fund. And that surprised a lot of people. Under what circumstances does this advice make sense for individual investors?
I love this. Thank you for bringing this up. I love this example. Keep in mind that Warren Buffett's wife, upon Warren's passing, he advised her to invest in the S&P index. But keep in mind two things. Firstly, she's not going to follow the fluctuation on a daily basis and really isn't going to be impacted if she sees a 40% loss in that. And then the second thing is, keep in mind that for her to invest all of her money or all of her inheritance in the S&P 500 actually diversifies her portfolio even more so than owning just Berkshire Hathaway, which has exposure to a couple dozen companies.
All right. Well, we'll leave it there. Barry, thank you so much for all your thoughts. Barry Glassman with Glassman Wealth Services. And after the bell today, Bank of America further cut its reported third-quarter profit by $400 million due to higher legal costs that were associated with a multi-bank investigation into foreign currency trading. You'll remember last week, Citi also revised lower its quarterly numbers for the same reason. The cyber attack on Home Depot's payment systems a few months ago is wider than originally thought. The home improvement chain now says 53 million more email addresses were exposed. That's on top of the 56 million cards that were compromised. Home Depot says the attack came through a third-party vendor's stolen username and password. Target was attacked in a similar way last year. Coming up, why one small European country is stirring up calls for reforming the tax code here in the U.S. The victorious Republicans are spelling out their agenda today. House Speaker Boehner and incoming Senate Majority Leader McConnell wrote an op-ed piece for today's Wall Street Journal. They're calling for tax code reform, moving on the Keystone Pipeline, cutting regulation on business, restoring the 40-hour definition of full-time employment, school choice, and encouraging employers to hire more veterans. Well, speaking of taxes, when you think of tax havens, what comes to mind? Ireland, the Cayman Islands? But what do you know about tiny Luxembourg? It's been hard to prove that Luxembourg is a tax haven because its tax rulings have never before been made public until now. CNBC, which produces this program, partnered with the International Consortium of Investigative Journalists to produce a report on one of the biggest leaks of tax documents. Dina Gosofsky has that story.
Over 500 tax rulings from 340 companies gives us an exclusive look into how multinational corporations are using Luxembourg to pay less taxes or avoid paying them altogether. 219 U.S. companies, including Mylan, Verizon, FedEx, and Amazon, have set up shop in the tiny nation. The way it works, accounting firms like PricewaterhouseCoopers consult with tax ministers in Luxembourg on behalf of the companies. They present the structure they want to set up, and most of the time, they get a seal of approval. That would be akin to a foreign firm going to the IRS first to arrange its tax burden. About $95 billion in profits flowed through Luxembourg in 2012 alone, according to the Bureau of Economic Analysis. On that, only about $1.1 billion was paid in taxes, so about 1%. If that money were repatriated to the United States at our current corporate tax rate, that would amount to about a $30 billion tax bill. Direct investment from the United States to Luxembourg in 2013 was $416 billion. Companies are able to shave off tax bills through a variety of ways, none of which appears to be illegal. For example, Luxembourg companies that don't necessarily operate in the country can borrow money from related tax haven entities, then relend that money to subsidiaries. The result? Billions are deducted as interest expense. International tax expert and attorney Stephen Plotnick gave this example.
The Luxembourg tax, for example, on $50 million of interest income that's run through it would be $100,000. So that's how much you pay for the privilege of setting up.
Which is nothing.
Nothing. And that's what you pay for the privilege of being in Luxembourg.
A spokesman for Luxembourg's finance minister told CNBC that he strongly rejects the fact that Luxembourg is a tax haven and says companies are instead enticed by its favorable business climate and political stability. But Luxembourg is feeling the heat. The European Union is currently looking into whether or not it has engaged in harmful tax practices. And in a twist of irony, former Luxembourg Prime Minister Jean-Claude Juncker, often credited with setting up the very tax structure that is currently being investigated, is now president of the European Commission, a branch of the same organization investigating Luxembourg's tax practices. For Nightly Business Report, I'm Dina Gosofsky.
For its part, PricewaterhouseCoopers, the accounting firm that represented all of the companies in those leaked documents, told CNBC that it's prohibited from commenting on specific client matters, but rejects any suggestion that there's anything improper about the firm's work. They said the documents were taken unlawfully by a former Luxembourg employee who then selectively provided them to the media. Well, if there's one thing that Democrats and Republicans agree on, it's the need to reform the U.S. tax code and to keep tax revenues here in the U.S., but they just don't agree on how to go about it. Joining us now to talk about the issues, Andrew Friedman. He's founder and principal of the Washington Update, a nonpartisan think tank. Andy, nice to have you with us.
Hi, Susie.
So this is a topic people have been debating for quite a while now. I mean, what do you think the chances are that we get reform in the U.S. tax code?
Well, you stated it right. Democrats and Republicans both say they want tax reform. It's like motherhood and apple pie. But one of the sayings we have here in Washington is tax simplification is complicated stuff. It's hard to get it done. And you have to kind of separate both the individual side and the corporate side and try to analyze each to see what the likelihood is. Well,
actually, I'm glad you brought that up, because when people talk about tax reform, it could mean corporate tax reform, it could mean personal taxes. Where do you see this whole debate playing out? Which category, or all of them?
Sure. Well, if you look at the individual side, you have to understand what you're doing is dropping the tax rates precipitously. And that means you have to recoup the revenue you lost by dropping the tax rates so the government doesn't end up worse off. And so you have to start doing things like curtailing mortgage interest deduction, charitable contribution, tax-exempt interest on bonds. Everything gets put on the table to try to recoup that revenue. And that's very controversial. It's very hard to get agreement on those kind of changes. And so I think individual tax reform that affects you and me is probably too heavy a lift for Congress. Putting aside even all that, you have to decide, are you going to try to bring in additional revenue with individual tax reform? Democrats say yes, Republicans say no. Corporate tax reform is a little more circumscribed. You're only dealing with corporations or businesses, and you're dealing with business deductions, things like accelerated depreciation and LIFO accounting. And everybody agrees you should have revenue-neutral corporate tax reform, not try to bring in more revenue for the government. That might be more doable, and that would stop, as you just pointed out in your last report, these companies moving jobs and moving money overseas to avoid U.S. taxes.
Well, how can that be avoided? I mean, is there a way to keep all of those profits and taxes on those profits here in the U.S. and so that companies don't have these tax gimmicks?
Yeah, I mean, if you want to change the system in the U.S., and now we're just talking about the corporate side, you want to lower the tax rate here so that companies aren't seeking out lower tax rates abroad. And then you have to make it easier for companies to bring back their earnings that are overseas into the U.S. Your report just noted that as long as the money stays, say, in Luxembourg, and the same would be true in France or England, there's no U.S. tax. But when that money's brought back to the U.S., there's a 35% tax. We're the only developed country that imposes the tax on that repatriation. And that's why you see companies moving out.
And real quickly, there's a lot of debate on reducing that corporate tax rate. What should it be? The CEOs that I talked to would like, 20%, 25%. The White House wants it higher than that. Will there be any kind of meeting of the minds on that?
Yeah, I think most people would say 25% to 28% would be a reasonable rate that would keep companies here if we make some of these other changes.
All right, Andy, thank you so much. Andy Friedman with the Washington
It's my
Update.
pleasure. Thank you.
Genworth reports a record loss, sending shares tumbling, and that's where we begin tonight's market focus. The insurance company suffered a huge quarterly loss from its long-term care insurance business. The CEO says the turnaround in that division will be more difficult than expected. The stock lost more than a third of its market value, closing at $8.66, making it the biggest loser in the S&P 500 today. Analysts cut their price targets for Qualcomm after that disappointing earnings report that we told you about last night. The chip maker missed earnings and revenue estimates and cut its outlook. Barclays, Canaccord, and Breon all slashed their targets on the company. That sent shares down 8.5% to $70.57. Kate Spade bucked the retail trend with its strong report today. The handbag and clothing maker met earnings forecasts and said its gross margins has expanded. Sales rose 30%, so it upped its guidance for the year. Shares popped 18% to $30.96. Orbitz shares got slammed after posting weaker than expected profits because of higher marketing costs. The travel website also lowered the top end of its 2014 revenue forecast, blaming the stronger dollar pressuring its international business. But the company's CEO was still happy with the results.
We announced a strong quarter. We delivered guidance for the full year of 9 to 10% adjusted EBITDA growth, and we delivered guidance for 2015 for adjusted EBITDA growth to be in the mid to high single digits. So it was a strong quarter, and we delivered good guidance. We're a business which is generating over $100 million of free cash flow a year, doing great in terms of key initiatives. So I can't really explain the reaction today. We're pleased with the quarter.
Despite those comments, shares fell 9% to $7.70. Strong advertising sales helped AOL post an increase in quarterly sales. More advertisers upped the company's automated platform to buy and sell digital ads. Earnings matched estimates, but investors didn't seem too impressed. Shares were off nearly 4% to $42.23. AMC saw its sales increase by more than 30%, led by growth in its international network. Even though results topped estimates, costs associated with the recent acquisition weighed on the entertainment company's profits. Despite that, the stock was up almost 3% to close at $25 and change. News about a trio of drug companies that are all working on Ebola vaccines. Sarepta's profit topped forecasts, but revenue was short of estimates. Tecmira posted a wider than expected loss, but announced it'll produce Ebola treatments for the Department of Defense. And BioCryst posted a wider loss on increased research and development expenses. Shares of Sarepta shot up 7%, Tecmira rose 4%, but BioCryst down nearly 7%. If you have a liver disease, the big drug companies are right in there with you, fighting for the dollars their exciting new drugs will bring in. The best known of the drugs can cure hepatitis C. They'll come under investor focus this weekend as researchers, companies, and Wall Street converge in Boston for the annual meeting of the American Association for the Study of Liver Diseases. Meg Terrell reports.
It's a battleground for hepatitis C, a chronic liver disease that affects an estimated 150 million people worldwide. Gilead Sciences has been dominating the space with its pill Sovaldi. With a controversial price tag of $84,000 for 12 weeks of treatment, the drug set a record for sales in its first quarter on the market. Now, Gilead's got a new pill, Harvoni, a combination of Sovaldi and another drug that can cure the virus in as little as 8 weeks in some patients.
With Gilead's launch of Sovaldi, essentially the best pharmaceutical drug launch in history. So given that this single drug is doing $3 billion plus in sales in a single quarter in the U.S., bigger than Lipitor ever did. It certainly shows why it's become a very, very hot meeting.
Analysts also expect data from competitors AbbVie and Merck, and are particularly watching an attempt by Merck to cut treatment times to as short as 4 weeks. But hepatitis C isn't the only focus. 2 other liver diseases have been capturing Wall Street's attention: hepatitis B and NASH, or non-alcoholic steatohepatitis.
Hepatitis C, I would argue, remains the focus because it's so commercially near term, and we're just seeing these massive sales figures right now. People are looking to the future to say, hey, is there anything else beyond hepatitis C?
And those markets, analysts say, are as big or bigger than hepatitis C. But efforts to treat both NASH, a chronic disease that can lead to permanent liver scarring, and hepatitis B are in much earlier stages of development. Companies working there include Gilead, as well as smaller biotechs like Intercept, Arrowhead, and GenFit.
Analysts say it may be years before we see the same progress in other diseases that we've seen in hepatitis C. This weekend will give investors a closer look at where we stand. For Nightly Business Report, I'm Meg Terrell.
Coming up next, with the holidays just around the corner, shippers are expecting a record season. But is everyone ready? The U.S. Postal Service is ramping up for the holidays. It says it'll add Sunday deliveries in major metropolitan areas starting November 17th and running right through Christmas Day. The USPS already partners with Amazon for Sunday deliveries. It expects to ship 50 million more packages this year, in addition to handling 12 billion cards and letters. The 3 major package carriers, the U.S. Postal Service, FedEx, and UPS, all insist they're ready for a record season of holiday business with no repeat of last year's disastrous trail of undelivered presents. Morgan Brennan has more.
48 days until Christmas, and shippers are bracing for their busiest holiday season yet, driven by online shopping. Today, the U.S. Postal Service saying it expects to ship nearly 500 million packages by Christmas. That's up 14% over last year, and on top of the 12 billion cards and letters that will also be sent. The carrier says it's taking big steps to meet the record demand, and not just brand new holiday stamps.
Starting on November 17th, it's 11 days from now, we will be delivering packages 7 days a week in many areas of the country. You're also going to be seeing our letter carriers out on Christmas Day.
That strategy will be watched closely. Last year, when UPS and to a smaller extent FedEx failed to deliver 2 million packages in time for Christmas, the Postal Service didn't have the same problem. largely because it partnered with Amazon for Sunday deliveries.
The relative success of its holiday performance has helped the Postal Service better compete with UPS and FedEx, luring hundreds of new business customers to Priority Mail. But while UPS and FedEx have poured hundreds of millions of dollars into network upgrades, expanded capacity, and more workers, some experts question whether the USPS has done enough.
They want to take a bigger piece of the e-commerce pie and be competitive with UPS and FedEx, but there's still grave concerns that the USPS is not built to handle these spikes of shipping volumes with their current infrastructure.
And it's not just the Postal Service. Between the three carriers, a staggering 1.35 billion packages are expected to ship this season, maxing out networks vulnerable to weather conditions, trucking shortages, and the very real possibility of another last-minute spike in online shopping. Still, all three insist they're ready for peak. But until December 25th, only Santa will know for sure. For Nightly Business Report, I'm Morgan Brennan.
And that is Nightly Business Report for tonight. I'm Susie Garib. Have a great evening, everyone, and we'll see you right back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
I'm Susie Garib with a Nightly Business Report news brief. Investors were encouraged to buy stocks today after Mario Draghi, Europe's top central banker, deepened his commitment to stimulating growth in Europe. Also helping, new claims for unemployment benefits fell more than expected last week. By the end of the session, the Dow Industrials rose almost 70 points to a new record. The Nasdaq jumped 17, and the S&P rose 7 points, also closing at a new high. Dow component Disney reported earnings right in line with analyst estimates, while revenue was slightly better than expected. And the cyber attack on Home Depot's payment systems a few months ago is wider than originally thought. The home improvement chain now says 53 million more email addresses were exposed. Be sure to tune into Nightly Business Report right here on your public television station.